These are the 5 scalping secrets that allowed me to flip $900 and over $9,000 in just 3 weeks. So in this video, I'm going to show you how to grow a small trading account fast, and the first step to do that is by eliminating mistakes. Now, if you want to stop blowing up accounts and actually be able to grow your account fast using scalping, you need to be able to eliminate all of your mistakes. There's 3 main mistakes that a lot of beginners make all the time. Okay, so the first mistake that you're going to want to eliminate is forcing trades. All right, now let's say this is you down here in the corner, okay, and you are trying to get to this level of consistently profitable, which is all the way up here. Okay, and to do that, you have 3 mistakes in the way. You have 1, you have 2, and you have 3. Now you get to the first mistake, and this is going to be forcing trades. Okay, now what does forcing trades actually mean? Well, what I can do is kind of show you a example. All right, okay, so the example would be something like this. Let's say you're waiting for a pullback and you want to get in when price reaches right here. Okay, but price doesn't get to it and it starts turning around a little bit, and you think you're going to miss out on the trade. So what happens is you decide to get in all the way up here when your original entry was all the way down here. What you're doing is forcing a trade. You're forcing your entry to be higher than where it should be. Okay, this is a massive mistake because when you go and take a loss and price comes all the way back down to your stop, which is down here, you're going to be taking a much bigger loss than you anticipated, which is not going to lead to consistent results and which is going to lead a lot more issues in the future. So if you're able to cut all that out, that's going to allow you to get to mistake number 2. Okay, so let's say you're over here, you have my brush, and you get past mistake number 1. Now you're on to mistake number 2, which is going to be revenge trading. It's a little bit different than forcing trades, but it's revenge trading. Now, revenge trading is something like this. Okay, let's say you're in long here and you do get stopped out. Okay, and maybe it's not in your plan to go ahead and get short. Maybe it's your plan to, just not trade the rest of the day because you're only taking a few trades a day. But then you see price start to slowly crawl back up, and then you decide to get back in. Okay, you start to revenge trade. You're getting back in not because you think price may keep going back up, but because you want to be right, because you have an ego and you don't want to lose. And you don't want to lose. You don't want to get stopped out. You don't want to lose any money. And so if you're able to eliminate this mistake, that's going to allow you to get to the next one, which is our third mistake. Okay, so let's say you stop forcing trades. Let's say you stop revenge trading. You get past that. And now your little guy is all the way over here to your third and final mistake. Now, the biggest mistake for this one is simply going to be using too much size. You can see if your account is growing pretty slow and pretty nice, it's very easy to keep that consistent growth. But you start growing really fast and too much size, you're eventually going to blow up and it's going to go down way too quickly. Okay, you see, a massive mistake that people have is that traders are looking to get to certain goals. So let's say they're down here and they're looking to get all the way up there. And what they do is they think that if I just get there quickly enough, I'll eventually reach that point. But some point along the journey, whether it's here or here or here, they end up crashing down. Whereas in the meantime, if they had just stuck to, maybe taking a much slower route and going a little bit slower, they would have gotten there in time. But because they didn't and they ended up going it the wrong way, by using way too much size, they end up blowing their account, going back, and they have to start back again, keep blowing up, keep blowing up, keep blowing up, and then they eventually never reach their target, which is all the way up here. So it's really important that you're able to not use too much size and slowly grow your account. And later in the video, I'll show you exactly how to do that. But once you're able to manage all of that and you're able to get past all 3 of these mistakes, you can finally go ahead and reach the money and have consistent profits just like that. Now, the second secret is going to be using key levels. Now, this is so important with scalping because if you're drawing random resistance levels or random support levels and trading off them, they're simply not going to work. There's specific levels and specific areas that you need to look at for scalping if you want to be successful with it. Now, a lot of these levels are not classic support resistance levels that you're used to. There's 2 different levels that you want to look at. One of them is going to be institutional levels, and these are where banks and institutions are buying and selling all of their shares. You also want to look at supply and demand levels. This is also where banks and institutions form zones where they're accumulating a bunch of different contracts and shares so they can move all of their liquidity. Okay, so institutional levels are trading levels that actually matter. Okay, they're not just classic support resistance levels. They're actual levels that institutions and banks will look at, and price reacts so well to them. So how do we actually find these levels? Well, a lot of these levels are based off of gaps. And right now I'm looking at a daily chart on Apple stock. Okay, and you can see that there's a lot of gaps in between each day because after hours and pre-market, the stocks will move and they will open different from when they closed the previous day. So you can see here we have this day where we ended up closing at about 194.69 and then we opened the next day about 195.08. Now, if we have a day where we open up either above or below the previous day's close and then we keep going, that's going to create a gap. okay? And you want to take the previous day's close where we had that gap and use that for your level, okay? So for Apple, the example would be right at the close of this level here, okay? And another example would be right here at this close, because you can see price closed all the way here, and we opened all the way down at 193. Now, when you have these levels, what you can do is simply zoom in on a 5-minute or 1-minute chart and zoom in, and you'll see exactly how well they react to these levels, right? So if we have this level from all the way back here, price came down, and what did it do? We came down, we came all the way back down to it, and we had a really nice bounce from it, okay? That's a really solid, easy trade you can do off this level. Again, same exact thing. Price comes down, we get a nice bounce right from it. You can easily scalp a few shares, or with options, you make 10, 20, 30% just off of scalping these levels, okay? Another example would be all the way down here, right? We have this gap fill level right here. When price comes down, what do? We come down, come back above it, and then what? We form another demand zone, which I'll talk about in a second, but we end up coming back down. We hold this level for another 10, 15, 30 minutes, and we end up rallying all the way back to the highs, okay? Then we come back to this level here that we had previously. You can see it acts close as resistance right here. More resistance, more support all the way over here, and we end up going higher after that. Now, these levels aren't perfect. You can see how we don't quite touch them to the exact tick, except we did right here. But you could still use these levels as a guide and have them draw as zones, right? So you can put a little bit below it, put a little bit above it, and it acts really, really good as pivots going forward. So this is one way that I find institutional levels where banks and institutions are getting in, because it happens right at the close of the day. Okay, so another way to find really good levels to scalp off of is something called supply and demand. Now, supply and demand is based off institutional activity, but the way that you find these zones is simply based off the speed of price, okay? So when you see price have a consolidation and then a very, very fast move higher with almost no pullbacks in this move, that's going to be your demand zone, okay? Right where that consolidation happened is going to be your demand. And the way you trade it is when price comes back down into that demand, that's when you want to be a buyer, okay? So let me go ahead and show you an example, all right? Now, if I can delete all of this, just like that, and show you an example here. Now, this is NASDAQ, okay? So when price comes back down into this demand zone, what do we see? We see price makes a move higher, we have a consolidation for a few hours, and then a massive, massive squeeze higher, okay? And we go right all the way up to the 1650 area, all right? Now, because we have this massive move higher, that shows us that institutions were buying all the way back down at the bottom, okay? And that's where that consolidation period is. Now, if you're able to draw the candle right before that massive move higher and use that as your zone, down to the bottom, you have a beautiful demand zone that you can use to scalp off of, okay? And you can just wait for price to get down into here, buy when price gets into that demand zone, put your stop right below, and get a nice solid 2.5 or 3R trade, simply trading off this demand zone. Another example would be something like this. So you can see how price comes down, we have a little bit of consolidation, and then we have a massive squeeze higher. Price goes all the way from 15,900 to 16,100, over 200 points in a matter of just like 3 hours, 4 hours, okay? Now, when this happens, what do we see? We notice that institutions were buying down here because we had that massive move higher. And what happens? Well, we look at the candle or the consolidation right before the big move starts, which is going to be this candle right here. We draw that as a zone, we extend it out, and what happens? Price comes back into that zone, and we end up coming back out of it. You can get a really nice risk-reward trade simply by entering right when price hits that demand zone, putting your stop at the lows, and targeting the next supply zone or the next high. You get a nice 3R trade simply off a trade just like this. Now, the third secret is going to be taking high quality trades. When someone asks me how many trades I take, I always tell them that I only take high quality or A+ setups. I never take usually more than 1 to 2 trades a day because I have to act like a sniper. I need to find the best trades out there. I'm sitting and I'm stalking and I'm waiting to shoot my prey, similar as a trader. Okay, I'm sitting there waiting for my setup. I'm not going to trade unless I see my A+ highest quality setup. A lot of people think more trades means more money, but it's typically not the case. In fact, the less you trade, typically the more money you'll end up making. You see, there's 3 different levels in trading. There's the beginner stage, and this is typically where you're not taking any good setups at all. You're just figuring out how to trade, you're still learning, you don't really know what you're doing until you get into the next stage, which is going to be the intermediary stage. Now, the second stage is going to be the break-even stage. This is really important because a lot of traders get to the stage and then they end up giving up, when really this is where you're very close to actually becoming profitable. And in this stage, a lot of traders have the issue with still not sticking to the highest quality setups. Okay, they may be taking a few good setups here and there, but they're ultimately taking a lot of more setups than they should. And another big issue with this is risk management, okay? You may not have your risk management dialed in at this stage, but sticking to highest quality setups is going to help you give that edge over your trading career so you can eventually reach the next stage. Now, the last stage is the advanced stage, and this gets to a point where you're able to overcome all of your emotions and only take the highest quality setups out there. You may see other people posting on Twitter or YouTube that they're making a bunch of money, but that's not going to give you any FOMO. At this point, you've mastered all of your emotions. You're only taking the highest quality setups. You're like a sniper, only waiting to take one bullet, one day, one trade, and that is it. If you're able to master this, you will become a successful trader, guaranteed. Now, secret number 4 is going to be sizing up too quickly. You see, when I started, I only had a few $1,000s in my account. I was trying so hard to take that few thousand and turn it into 100 grand in a few months or just a few weeks. And because of that, I sized up way too quickly and ended up blowing up over 12 different accounts in my trading journey. And I lost about $15,000 in the process. You probably don't want to hear this, but the best way to size up is actually by taking it slow. You always need to think about it like a workout example. If I'm going to the gym and I'm working out and I'm starting with 50-pound weights for a chest press, I'm simply not going to go to 80 pounds the next day or the next week. I need to slowly increase my size and increase my weight, because that's how I'm able to afford to be able to bench press that much weight. Okay, it simply would not work if I tried to jump from 50 pounds to 80 pounds in just a few weeks. You need to do the same with your trading. You simply cannot just keep compounding your account week and week after week until you try and take it to $1 million, because at some point you're going to blow up. So let me show you exactly how you should size up and compound the right way. Okay, so this is how I compounded my account, and in my opinion, the best way to do it slowly and consistently to get really good growth. Now, let's say you have an account with $10,000, and at this point, you're consistently profitable. You're making money, you eliminate all your mistakes, and you're scalping with a strategy that actually works. And after 2 weeks, you're bringing the account to $12,000, and you're up $2,000 in profit. Now, at this point, every single week or every single 2 weeks, what you want to do is take your profits out, but you don't want to take all of them out. What I recommend you take out either half or 75%. So in this example here, we make $2,000. So what we do is we take out $1,000 into our bank, locked in, profit, gone, and then we have $11,000. And then what we do, another 2 weeks goes by, and simply like this, we turn that 11 grand into 15,000. And how much do we make? We make 15,000 minus 11, which would be $4,000 in profit. So what do? We take out $2,000, the account's down at 13, and then we reset. And just like that, we're taking money out of our account every single week or every single 2 weeks. And that allows us to stay consistent, not size up too quickly, and also help grow the account while also making income, right? Throughout this 4-week period or 6-week period, we've taken out $3,000 in profit. We've already made $3,000, and our account has grown from $10,000 to $20,000 in this example. So what I recommend is you always think about taking money out while also leaving some in to help compound and grow at the same exact time. You can change the variation of this however you want. You can do it every 1 week. You can do it every month. You can take out 75% or take out 25%. The goal is that you're doing it consistently, slowly, and also taking home income, so you're not going to size up too quickly, get over emotional, and end up blowing your account. Now, the 5th secret is going to be constantly improving. See, even as a scalper, you want to make sure that you're improving your methods every single day. Even after trading for 6 years and having a successful strategy that I still use every day, I'm always looking to improve. I'm still backtesting, still forward testing, journaling all my trades to see what I can improve on. The best way to improve every day is honestly by just improving in your actual life. You see, trading is all about the good psychology. If you don't have good psychology, you are not going to become a successful trader at all. What you need to do is actually take life in your own hands and get better with your workout, get better with your diet, get better with reading every day or with your habits. If you're able to stick to all of these habits and have that good discipline, that's going to translate into your trading. And honestly, after trading for so many years, that has probably been the #1 key indicator that allowed me to become profitable, because I eventually realized that I wasn't disciplined in my own life. So of course it's not going to translate in my trading. But once I figured out I was able to stick to a workout routine, I was able to stick to a diet, that all translated into my trading, and I immediately saw much better results. Scalping at the end of the day is not easy, but if you're able to apply these 5 secrets I just told you in this video, it is 100% going to make you a better trader, and that is something I can guarantee. Hope you guys did enjoy this video. If you did, click the link below to watch a free training on my exact trading strategy. It's a 3-phase system. I go over step by step exactly what that is. So check out that free training down below. Leave a like, subscribe, and I'll see you guys in the next video.